Kitty, could you share with me images and flexible budget if you have? The ones I have not really clear, like you saw. Kindly, if you could share with me those equation and flexible budget and look at it. So as somebody shares the question, flexible budget, like I emphasized, it looks at a fixed budget and then tries to make sure the budget matches with the actual. The way it does that, it doesn't just come and say, or then just put it in a way that just transfers the costs the way they are from say standard or the fixed budget and takes them straight to the actual. No, what it does is the level of activity is where the issue comes in. That for a fixed budget, you may find that when you're budgeting, you anticipated say to produce 10,000 units. And therefore your budget reflects the production of 10,000 units. Now, if your actual production is actually 8,000 or 12,000, in other words, it's different from the fixed budget, then the flexing comes in. That you flex the budget such that the level of activity is the same as the actual level of activity, so that you match them together. I usually use an example of if you're comparing two ladies, for example, okay, you're not going to compare the short lady and the tall lady. Okay, when you're comparing the two, it won't make you won't be fair. So what we do is we get two tall ladies and compare them. So the same thing with the flexible budget. That's unfair to compare the fixed budget, which was produced probably on a particular level of 10,000, and then you want to compare it with the actual performance, where you produced or you might produce either more or less in terms of units. So the flexible budget comes in to do that, to bring two either short ladies or tall ladies to compare them together. So that's basically flexible budget, and we're going to see how we do that. Okay, someone has given me, okay, but the technique is the same, so there's no problem. So that we see why we do something.
Wait,
why we might do that.
It is very impossible for her to wait for you.
Okay, so guys, please mute. If you join in, can mute. Okay. The one you have shared is also fine, but this one doesn't pull out what I wanted really to show. However, it's cover. It's fine. Now I don't know this one. I think it's fairly clear. It is called Pasca Limited. Okay, you're given additional information. If I may just take you to the last part of the information. Okay, the last part of information says that Kit, I don't think your image is clear. But for purposes of learning, let me just take the other part. Let's just do the other part. The other image of share is not clear. So this is the information. They will tell you, ideally, they wanted him or her to comment on the performance of the entity by just looking at this, looking at your budget and your actual. What can you comment in terms of costs and variances? So what we do is under budgeting or under cost accounting and management accounting is you look at your budget. In this case, they're giving us a budget of production and sales units. You have 5,000, and then you have revenues and expenses as they're here. Then you're given the actual, and when you check the actual, the production and the sales value is 8,000. Yeah, in terms of units, and then you're given all these others. Now, flexing budgets, like I already said, you can't compare these two budgets or these two performances, and the reason is clear that this guy is short and this one is tall. Yeah. So what the flexible budget does is it flexes the fixed budget so that it's the same height as the actual budget. So what we're going to see. Okay. Let me go and check. Okay, I hope this is now clearer. Yeah. So they're saying required says that prepare a flexed budget that will be helpful for management control purposes by clearly bringing out the budgetary variances and the net profit. Okay, so yeah, they were specific. They're telling you to flex. Another day, they will not tell you to flex. They will just tell you determine or using management knowledge, determine the variances and comment accordingly. They won't tell you to flex. But a normal guy or a normal accounting student, cost management, should know that if the budgets don't reflect the same production level in terms of units, you can't compare those. Okay, you need to make them have the same heights. So without waste of time, this is the information here. So our issue is, or our challenge will be, you need to produce a flexible budget that reflects the same level of activity as the actual in terms of units and production. So let me therefore share my worksheet. Okay, I'll do a few slowly, then the others I will do faster. So try to appreciate and ask where you've not understood. Okay, so we're saying having budget. These are, you have details, then you have the fixed budget. The fixed budget is the one that they give. They don't have to say that this is fixed. Just once they give you a budget that they made before, that doesn't reflect the same level of activity as the actual, automatically it becomes the fixed budget. Then you have the flexed budget, which you're going to compute. Then you have the actual performance. Actual performance, you're not going to do anything. You're just going to record whatever is in the question, you bring it here. Okay, these are recordings. So just like the fixed budget also, you don't do anything. Just the way it is given is the way you bring it here. So I'll be going forth and back to the question just to be sure to be on the same track. So the first one is the production and the sales units. That's the first line. Okay, move downwards. So my worksheet therefore should reflect that also. That you have the production, and sales in terms of units. So we're saying that for fixed budget, the way they have given to you the question is the way you put it there. Don't think. So I've said 5,000. And they said the actual is 8,000. So your flexible budget must be the same as actual in terms of units. That's the first step of flexing. And I hope we're okay here. Okay, we're saying the flexible budget comes in to make sure that the guys have the same heights. Okay. So fixed, the budget had 5K. You're saying let the budget have 8K because the actual is 8K. So that you compare. Then you go to the next line. The next line says that sales revenue 50M, then 80 sales revenue. So come and say sales revenue. You're saying the 50M, here the 80M. So flexing, what do you give it to you? Now flexing, you look at the item they're referring to, sales revenue. Okay, and I remember telling you something to do with variable and stuff like that. Now all that sales revenue change with increase or decrease in the sales units to selling. Okay, that by fact that sales revenue is equal to the selling price times the number of units sold. So using this information, you apply it on a fixed budget so that you determine the selling price, because you don't have the sales, but you know the units, right? So you will say that I don't want to really do a lot, but we're saying the selling price is equal to sales, which is 50M, divided by the number of units, which is 5,000. This is 5,000. Okay, which will be equal to, I think, 10,000. So that is the selling price, meaning that at our level of 8,000, it can only be the 10,000, which is the selling price, times the number of units that you're producing, which is 8,000 in this case. Okay, so by doing this, you're flexing the budget. Then you compare what we call variance. Compare the actual and the budgeted. You're comparing total guys now. When you compare the total guys, you are seeing that the variance, there's no variance here in terms of revenue. You have a 0. Okay, I hope you have seen that. I'm going to the next item. Let me leave it there just for you. The next item is direct materials. Now, regarding this information in the table, preferably always consider the additional information first, because it tells you clearly which item you should go for first. And respond to your chats. Pardon, revenue, please. Okay. Back to revenue. We're saying revenue. Our fixed is 50,000, and our in terms of shillings revenues, then our units in sales are 5K. So we're saying if at 5,000 units, you're making 50,000 million, how much will you make if you're selling at 8,000? If you're making the 8,000 units, sorry. So I'm saying the first thing you do is to determine the selling price. By looking at the item sales revenue, we are saying it's variable in nature. Why? Because it changes with the number of units or with the level of activity. And I'm saying by formula or by computation, we know that sales revenue are given by the selling price times the number of units sold. This is what makes it variable. That change in number of units will definitely affect the sales revenue. So we're supposed to determine the selling price because for it is always constant. This is a standard price that you agreed upon as far as the fixed budget is concerned. So I'm saying the selling price is 10,000. Okay. I don't want to put all the zeros here. It is 15 million, 50 million. 50 million divided by 5,000. Okay, let me put it again. Like 50M is equal to the selling price times the number of units produced. In this case, the number of units produced were 5,000. So what's the selling price? Okay, selling price we're saying is equal to 50 million. Okay, the revenues divided by the 5,000, which is the units. I'm saying I'm going to get 10,000. So when you're flexing, you're saying the number of units have changed. they're not 5,000 anymore. They are what? They're 8,000. Therefore, my sales here, using this formula, my sales is equal to the selling price, which is 10,000, times the number of units, which are 8,000 under flexible budget. That's how I'm getting the 80,000 here. Katie, I hope we are fine in this case. Okay, you may confirm if you have left behind. So let's go to the information. The other information is you look, like I said, always deal with the information first. Otherwise, you will adjust an item, then they tell you later in additional information that it's totally different. So direct materials was given additional information. They say that direct material and direct labor, let me just stick to direct material. Direct material costs are variable. Once they say variable, like I've already saying, what you have done for selling price or for sales, it's the same thing you do. That we're going to say direct material. Direct material, we're saying it's variable in nature. Okay. Under the fixed budget, it was 12,000. 12 million. Then for actual, it is 14 million. So ask ourselves, under flexible budget, what is the value? And I'm saying, because it's variable, we're saying that the variable cost is given by variable cost per unit times the number of units. Okay, so automatically, the variable cost per unit for direct material must be 12 million divided by 5,000. So what you get as variable cost per unit, variable cost per unit. I think it's going to be, this is 12 million, sorry, divided by 5,000 is 24. So variable cost per unit is 2,400. So meaning that for flexible budget, it's going to be the variable cost per unit, which is 2,400 times the number of units produced, which are 8,000. So for this one, we shall have 19,200. I hope we are together. As far as direct material are concerned, their variable costs, they change based on number of units. So just get this. Okay. So the variance is you compare total, guys. This minus that. So you have 5.2 million. So for variance, we comment whether it's favorable or adverse or unfavorable. So here, with the cost, of course, if you spend a lot of money, then you're not good. You're not doing fine. If you spend less money, then you're doing okay. So now in this question, direct materials, we spent less money compared to what we had budgeted for. So that is a good thing. If you spend less, that is a good thing, hence favorable. Okay, that's how we get direct material. Pardon, on 11, the 1992. We are saying that direct materials are variable costs. We are saying variable cost, total variable cost is given by the variable cost per unit times the number of units produced. Yeah. So if 12,000 million, 12,000 million, 12,000 million, supposed to be given by the variable cost per unit, which I don't know right now, per unit. I don't know, times 5,000 number of units under the fixed budget. We're saying what is the variable cost? The variable cost per unit must be equal to 12 million divided by 5,000, and you'll get 2,400. That's the variable cost. We're saying therefore variable costs when the number of units is 8,000, it it must be equal to the variable cost per unit, which is 2,400, times the number of units produced or sold, which is 8,000. When you apply those, you'll get the 19,200. Dear, I hope I've answered you. Why do we multiply by the 8,000? That's the whole instance that we are flexing the budget. Yeah, that at the level of 5,000, if it is for direct materials, we are spending 12,000. And the reason is clear that the variable cost is 2,400, and therefore 2,400 times 5,000. Automatically, I have to get 12,000. So we're saying if the 5,000 has changed, the level of activity is now 8,000. What will be the figure? We're saying that the variable cost per unit doesn't change, but the level of activity has changed to 8,000. That's why I'm getting the 19,200. Esther, I hope I've answered you. We're multiplying by 8,000 because we are flexing. We want two tall guys to compete, not a tall guy and a short guy competing. It won't be fair. So that's why we're trying to make the 8,000 flexing. Esther, I hope I've answered you. Is our 8,000 another unit? What do you mean another unit? Kate and the others, for those who are getting confused, we are saying that under budgeting, when you're making the budget, you have a particular activity, level of activity that you project when you're making it. But when the actual happens, usually what you budgeted for as the level of activity is different from your actual. And because of that, you don't throw away your fixed budget because it's not the same as what? It's not matching in height, the same as actual. No, we are saying that you use the fixed budget to flex so that the level of activity is the same. Like I already said that the fixed budget, you find that the activity is usually different from your actual for obvious reasons, because of the uncertainties and the future. Okay, that budget is formed looking into the future, but hasn't happened yet. So due to uncertainties, your budget will always be different from your actual. But we're saying that if that happens, then always consider the level of activities. That if you produced 5,000 and your budget was 10,000, you cannot compare the costs you incurred in producing 5,000 with the ones that somebody would incur in producing 10,000. We are saying by doing that, you're comparing two people of different heights. You're not going to get what you want. You're saying get people of the same height. And this is why we're saying that the flexible budget comes in. It comes to make sure that whereas the budget is there, yes, you set your prices and standards, yes. We're saying if our level of activity was just 8,000, let the budget match the what? The level of activity. Let us have the same heights and then you compare us together. This is why the flexible budget is coming in. You're flexing it. I don't know whether I've made it clearer or even I've worsened the situation. But basically we're saying you can't compare 5 and 8 together. Let 8 and 8 compete. And that's what you're trying to do. How did we get the 5.2 million variance? You compare the budget and the actual. Okay? That you have 19,200 for the budget. Okay, now officially comparing two tall people. Okay? 8 and 8, two tall guys, you're comparing them. Now when you compare the two, our actual was 14 and our tall guy now, the budget is 19,200. When you compare the two, the difference, okay, it doesn't matter what comes first or comes last. The difference must always be positive. Okay, big minus small. So it's 19,200 minus 14. You will get 5,200. Then you comment. When you comment, you're saying that is this variance favorable or unfavorable? And I've said it's favorable in terms of cost if you're spending less. It's favorable in terms of revenue if you're earning a lot. As simple as that. I hope I've answered you, Esther. Okay, thanks. Okay. I hope I've answered you. If you have any other questions, please feel free to ask them. I'll be able to respond. So let's continue. So we're done with material. We go to the next line, which is okay. So let me use this additional information. They're saying direct labor. Direct labor is also variable. So direct labor is here, 8,000 and 9,000. I go and do the needful. Direct labor. Okay, 8,000 under fixed. Sorry, 8 million, and then 9 under actual. Okay, the flex has to come in because, like I said, the 8 is for 5,000 and the 9 is for 8,000. The two are not compatible, or we can't compare them. So they have said direct labor is variable. So if it's variable, you do the same thing you've done for direct material, if you understood. Okay, and so this is getting the variable cost per unit. You're saying what was the variable cost per unit as far as labor is concerned. This is the 8,000 divided by 5,000. What are you getting? I think it should be something like 16,000. Can confirm. 8,000 divided by 5,000. You get 1,600. Okay, that is our variable cost per unit. Therefore, for us to get our fixed labor, we shall get the 1,600 cost per unit times the number of units, which are 8,000. Okay, so we are getting 12,000. Okay, then you get the variance. And the variance, I said, it is big minus small. Okay, big minus small. So it is 12,800 minus 9,000. You have 3,800. Then you still comment. And we're saying here, we have spent less since the expenses, and this is favorable. Right? So that's what you do for variable. Let me go to another item. I'm not going to do the one of maintenance, since it's also variable. You have got the technique. You can go to depreciation. Depreciation, they didn't talk about it, so I won't also do it. Otherwise, once they don't talk about an item, you leave it the way it is. You assume it is fixed. Okay. When we go to, they said here, rent and rates are fixed. So those are obvious. If they are fixed, that means that at any level they remain the same. Okay, so let me take those ones since they're obvious. They have said them over there. So you come here and you say rate and rents. For fixed budget, rate and rates is 2,850. Then under actual, it is 3A. So under flexible budget, it has to be what? 2,850 because it is fixed. Yeah, 2,850. Fixed cost do not change with level in activity. So that was rate and rates. Let's look at other costs. Is where there's a bit of a trick. Now the other costs, yeah, they say that other costs, this one here, 5.2 and the 6.1. They say that other costs include fixed costs of 2,600, 2.6 million, plus a variable cost of 3 shilling per unit. Okay. Now these are what we call semi-variable costs. They have a fixed component and a variable component. Okay. So in the question, it was given as that, and for variable, it was given as 6 point. It was given as 6 to 5,000. Okay, so the question was clear. The statement is clear. I say that these other costs that you're seeing here, you must bring a fixed cost of 2.6. Then on it, you add variable cost. We're saying variable cost, okay, which is given by 600, which they have said that this variable cost here is a component of the variable cost per unit of 3 shillings, 10 times the number of units that you want to produce. In this case, there are 8,000. So the figure you get there is the answer. Is to 600 plus 3 times 8,000. Okay, you get 2.6. Can respond to some of your chats. Guys, skipped maintenance. Yes, I've skipped it because I said it is the same as direct labor. We are doing it like direct labor. Yes, they are the same because it is variable. So if you're gotten how to deal with variable, then I didn't have to do it. Dear, I hope we are fine. Then Esther, what if rent wasn't fixed? Would that mean we have to flex it? Yes, if it's not fixed, you flex. If it is fixed, you put it the way it is because it is fixed. That doesn't change with the change in level of activity. Okay, Esther. Then other costs, I hope we're together on other costs. They were clear, the information is clear. They said that for other costs, what you do is other costs is 0, other costs, the last line, that they include fixed cost of 2.6. Then on it, you add a variable cost of 3 shilling per unit made. Okay, and sold, per unit made and sold. So the variable cost is this, the variable cost per unit is 3. So times the number of units, 8,000. And you are good to go. So unless you have any questions, guys, that is how we flex budgets. Okay, and then you comment accordingly. Variances, I forgot to do these ones. Now for this one, you're saying big minus small. So it is now 3M minus 2.8. So it is 150. But these are costs. And here we're saying now this time you have spent a lot. You have spent more than the budget. So this one is adverse, or aka unfavorable. Once adverse, you say unfavorable. They're the same things. Then still other costs, you spent a lot, far more than what? Than the budget. Yeah. So still this is adverse. You don't say unfavorable, you can say adverse. And by doing that, you're done. Yeah. They told us to do a profit or loss statement, but idea is it revenues minus expenses. So any questions regarding flexing? Because okay, there are many ways that they set this flexing bit, but this one is one of the common ones. Where they give you the fixed budget, they give you the actual. They tell you that you compare or you get as variances. Don't be so fast to just subtract or actual minus fixed or fixed minus actual, getting the difference. First, make sure that the level of activity is the same. You can't compare what? Two ladies of different rates. It won't be fair. As simple as that. I'm class UI. They gave us percentage stuff. Yeah, I know. And they're not any different. Percentages just help you to get this part here. Okay, unfortunately, there are 3 minutes left on the link. I wish I could share some of the questions. Now, like this one here. For those who are asking what percentages, they said, okay, it's not clear, but just try to bear. They say that GBK Dairies Corporation attains sales of 6 million at 80%. 6 million at 80% of its normal capacity, and its expenses are as below. Okay, so the expenses. Now, in this case, they give us shillings, but most of the times they give us units. Okay. Now, at 80%, you have 6,000. You ask yourself, how about 90%? What will it be like? Okay, or 100, what will it be like? Or 110. What happens is, if I may just show you the working, the information will always be clear. They've told you that. Now, like in that case, they said that sales, they are 6 million. This is when it is at 80%. So then they ask you, then they'll ask you at 100%. Yeah, okay, 100. Yeah, 100, for example. At 100%, what will be the flexi? The task here is, okay, these were given shilling, but most of the times are in units. I don't know, they made an error or something, because level of activity is based on units. Unless they gave us a selling price, which I think they did. Let me confirm. Okay, I may not be able to confirm because of the time. So, but otherwise, I think I must give you the selling price so that you get the number of units. So this is simple. You say that 80%, 80% represents 6 million units. Okay. Now, how about 1%? Cost will represent 6,000, 6 million, divide by 80. Okay, then 100% will represent 6,000, 6 million times 100 divided by 80. That's how you get the number of units. Okay, so, and you do the way we have done. Number of units, then you flex. 8K is always, no, it's not always the level of activity. It depends on the information. Okay, so guys, the link is done. Okay, it's going to close shortly. Thank you for attending. I will upload this. Feel free to subscribe to my YouTube channel and have a feel of the many videos I have there. I discussed consolidated, try to look through it. And yeah, I want to wish you really the best in these final exams. I hope to arrange a tax class if time allows. Otherwise, thanks. A good night.